Honorable CAs, welcome to our today's program on succession planning. We heartily welcome our CA ARAVIND, who will share valuable insight on succession planning. I request all to rise to our motto song.
Yeshasupeshu jagrati Yeshasupeshu jagrati Kamam Pursho Nirvimana Tadev Shukram Brahma Tasmin lokah shataha sarve tadunatyati kaschan etadvaita Arthashastram, Dharmashastram cha, meaning economic principles, earth, and ethical considerations, dharma, which are central to the work of accountants. The entire world is deliberating about the impact of climate change coupled with disruptions of artificial intelligence. India has given philosophy of Vasudhaiva Kutumbakam to the world and successfully hosted G20 summit on this theme and also launched Global Biofuels Alliance. The accounting profession also has an enormous responsibility to guide the work, where accountability meets innovation so that vision can be converted into solution. The Institute of Chartered Accountants of India, being the world's largest accounting body after the successful hosting of WCOA 2022 and GLOBAC, proudly presents before the World Forum of Accountants 2025. Where accountability meets innovation for a sustainable planet. The world's brightest minds will exchange insights, explore emerging trends, and unlock the possibilities for the profession, where foundation will be laid to shape the vision for the future of accounting profession. Hosted at Yashobhumi, the largest convention and exhibition center in the heart of India's capital, New Delhi, inaugurated by the Honorable Prime Minister Shri Narendra Modi, is all set to host the congregation of accountants from around the world. And while you're here, experience the vibrant culture and heritage of New Delhi, a city where history meets modernity, offering unforgettable memories.
World Forum of Accountants, an experience of 3 days, insightful discussion, groundbreaking innovations, and unparalleled networking opportunities.
With immense pride, we invite you to WOFA 2025, taking place, happening from January 31st to February 2nd, 2025, at the magnificent Yashobhumi, New Delhi. Experience 3 days of insightful discussions, groundbreaking innovations, and unparalleled networking opportunities. World Forum of Accountants 2025 is where you need to be, where accountability meets innovation, AI for a sustainable planet. Join us at WOFA 2025 from January 31st to February 2nd, 2025 at Yashobhumi, New Delhi. For more details, visit wofa.icai.org.
My pleasure to introduce CA ARAVIND sir, who has been more than decades of experience in advising clients on diverse income tax and regulatory requirements. I request C. Sugavanam sir to on the shot and present the momentum to CA ARAVIND.
Photo.
Hand over to the speaker.
Navigate through this presentation, but of course we can have it free flowing. Any doubts, any perspectives, more than happy to take. So this term succession planning has multiple connotation, depends on where we place it. So effectively, so you have roles like management roles, you have family roles, you have ownership roles. All of these roles require succession. Effectively, because let's say the baton gets passed down from, let's say, one generation to the other generation, and so on and so forth. Particularly in the context of today's discussion, it's more about ownership aspects. But what I like to also emphasize is that this succession is also an important aspect, more from a management perspective, because like the ownership of assets transition between one generation to the other, the management of assets and management of business is also an equally important subject that is being considered by families, by growing families and larger families to that extent. So, but for today we'll focus on the ownership aspect. What we have over the next 90 to 120 minutes, what I have to share is a broad overview about how is ownership structuring, succession planning broadly thought about. And in the context of today's discussion, it's on discretionary and private trust. So we'll deal with what is a trust structure from a succession planning vantage. The third aspect is how is taxation of private trust, discretionary, determinate, non-determinate, these kind of trusts, how are these taxed under the scheme of Income Tax Act. And there are certain other aspects that I wanted to cover. These are more from FEMA and ODA aspects if we have some time. So firstly, getting into the first part, why is succession planning relevant? It is becoming increasingly relevant as we go over years, increase wealth, increase business, increase family strength is increasing, all of that. There are multiple reasons which we come across when we are discussing, when we interact with family businesses. First aspect is the legacy that is being built, let's say a brand that is built by a family or an individual through a family. How to preserve the legacy of that? Two things. One, how to preserve and how to also grow that. Here what I told with respect to ownership management, both of it goes hand in hand. One is about how to protect that legacy within the family. Let's say there is no third party who comes on to sort of disrupt a particular legacy, or let's say a particular business or a particular unique proposition that a family has built. And the second point with respect to management, how is that sustainable in the future? Only with an effective manager or an effective person from the family who is able to take this forward, a legacy is preserved. So that is one of the primary reasons that is being considered from a succession planning standpoint. The second one is safeguarding asset. Clearly, what we have seen is what are the instruments that you have to pass on a wealth from particular generation to the next generation. There are multiple forms in which assets can be protected. So the best way of putting it is, it's not just being protected, it's being utilized. It's being preserved and utilized and passed on to the further generation. That is the second aspect, it's about safeguarding assets. Transitioning to the next generation. How do we transition the assets along with the responsibilities of managing the assets to the next generation? This is another important aspect. Continuity planning. How does a person or a group of persons define the management of a business or an asset after their lifetime? Let's say, for example, if a person is at the helm of an affairs of his business and assets, so let's say if it is passed on to the next generation, what kind of instructions can they codify? How do they bind the next generation to comply with them in their absence in the future? Or let's say in their retirement or after them becoming inactive, so on and so forth. So that is about continuity planning. Consolidation of family wealth. As business grows, as owners grows, as family grows, what happens is the family becomes quite large with different parts of family owning different parts of the wealth. But how do you present a single face to the public, to the stakeholders at large? How can you unify all of these representations together? That is one other aspect, because when we move, when it gets dispersed over multiple fractions of family, there is chance that one may do well, the other may not do well. There could be varied interest in different businesses. There could be business where the family is interested but the unit is not interested, so on and so forth. So it means you have to present a more consolidated approach. So what is the vision of the family towards a particular business, particular ownership, particular asset, and how is that not diluted as time passes? Last one is planning for inheritance tax. Of course, that's something that is forming part of this presentation for the last 1 or 2 decades. So that's taxes. I would say that tax is last of the concerns in a succession planning or an estate planning. In our experience, it's not a tax planning tool by any chance. It's more about how assets or wealth or businesses are governed, are owned, controlled, governed, expanded, so on. So this is broadly about it. This is the overall contours with which anybody in current times, they are planning for their succession. There could be different kinds of wealth with different exposures from the family. So all of these are considered for anybody to sort of to give their baton, or let's say to preserve and give it to the next generation. So that is something very critical. What are the modes of succession planning? First one is a family settlement. This family settlement is a once for all sort of scheme, okay, wherein let's say 5 different, or let's say 10 different businesses are owned by 3 different factions of a particular family, crisscross. There are assets which are owned by one individual in the name of other, and all of these are being discussed between families, and they arrive at a settlement to say who owns which part of the company, who controls which assets, and who will be the managers for each of these different businesses. So families come together to write down exactly what they think. Let's say A, B, C, three parts of the family have 10 different entities that each of them hold shares. So what happens is, let's say A wants to control first 3, B wants to control the next 3, and then C wants to control the last 4. So while the shareholding is spread across all the 3 parties, the families sit together and write down exactly how do they want to own all of these, and then settle all of these shares. Let's say A owns a share in the first company, A also owns share in the third. So third one is swapped to C, and then A gets C share in A. Something like that. So it's like a give and take in a family arrangement. That's the first step. In that kind of in a family arrangement, what happens is, after the settlement happens, it is A family which controls the first 3 companies, B family owns and controls the second 3, C owns and controls the next 4. It's not like A, B, C are going to consolidatedly control all of the 10 companies. So that's a particular way of dividing assets. That is a family settlement. Will is a commonly understood instrument where assets are passed on after the lifetime of a particular person. So it's being written exactly what assets will go to whom, and this has to go through a court process to be implemented after the lifetime of a person. The third one is a Hindu undivided family structure, HUF. This is very least used structure, wherein the members, the co-partners, will be able to enjoy and pass on the assets. The fourth one one is a holding company structure, wherein, let's say if I own 10 different assets, asset class, I'll put all of that into a holding company, okay? And we all know that company has perpetual life, unlike us. So which means that the company, as long as the company thrives, as long as the company lives, these assets are held within a company. So which means we are ensuring a longer time period for the company. But still there arises one question. Who's going to own that holding company after a person's lifetime? Who's going to manage the company after a person who gave the company all the wealth they have? So that's another question that comes up. There is no particular definition. We'll have to go by the company law definition as to what a shareholder can do, what a shareholder can't do, what a director can't do, what director can do. So all of that complications comes in, but still the assets are moved into a corporate structure, which means the assets can be held longer than natural persons, right? We can go forward, but still there are some difficulties around it. The last one, which is prevalent from a succession planning standpoint, is a trust structure. So the trust structure is prevalent for multiple reasons, which I'll probably capture in the next slides. Effectively, a trust means an obligation on the trustee to deal with the assets and liabilities that are transferred to them for the benefit of the beneficiaries. Okay. So a trustee will hold the assets, incomes, liabilities, expenses, everything, and manage it on behalf or for the benefit of the beneficiaries in line with the conditions that are imposed by the settlor, whoever gave the asset. So that is a trust. And trust is not a corporate form, trust is not a separately identified individual of sort. There are different complications around that, which we'll discuss in the next 60-70 minutes. So these are the 4-5 prevalent structures that are seen. While trust is largely the first of all of the top of all of this, depending on let's say, for example, if an immovable property were to be immediately settled into a trust, we will attract a stamp duty of 9% in Tamil Nadu. But if it can wait till the person's lifetime, so you can move it into a trust through a will, okay, or you can move it to a person through a will. Okay. So which means we are deferring the cost of a succession planning. So succession planning along with it, there are some costs to ensure that we put together a firm structure around it. So all of these are interchangeably usable, but largely what we have seen is trust structure being the most prevalent amongst all of these. Getting into specifics of the trust structure. So in a trust structure, it's not a company, it's not a partnership firm, it is not a limited liability partnership, it doesn't have a separate corporate kind of an existence. Okay. So what is a trust? So a trust is basically an instrument. It's an instrument that is created by a settlor. And who's a settlor? A settlor is a person who owns, let's say, who owns and gives away a property to the trustee to deal with that property as prescribed for the benefit of the beneficiaries who are stipulated. So let's say I have a property which I would like to pass it on to, let's say, somebody else, but I would want to have some controls over the property. I would like to manage the property, but the incomes of that property should go to that person. So if I drop the property into a trust, and if I say that there are A, B, C, D conditions that the trustee has to follow, and once the income is coming, it can go to, let's say, X, Y, Z in particular portion, and let's say 40% of income has to go to these 3 people, and then 60% has to go to the corpus. All of these can be written in a trust, which is not possible in any other kind of instrument. So we'll go through each of these definitions because it's going to be very critical in terms of the tax aspects. These are going to be very important. So like I told, the first person is who initiates this is a settlor or an author who transfers or who creates the trust, writes down the trust deed, and then gives out the property to the trust. A trust can be an oral trust, but any trust that involves an immovable property has to be written. Generally, it is preferred to be a written trust to have clarity. So, settlor starts the trust, writes out the trust, defines what is the roles and responsibility of each of the parties, it identifies beneficiaries. It can be current, it can be sometimes future, it can be conditional, it can be unconditional. So all of these are written out by a settlor and a trustee, and the property is given to a trustee. Settlor is the first one. The second one is a beneficiary. Generally, what we see is that the ability to earn income, the ability to receive income is also associated to ownership of the property. For example, if I have shares, I can get dividends or capital gains. If I have a an interest-bearing instrument, I own the interest-bearing instrument and I get interest. I own the house, I get rent. So here it is a bit different. The beneficiary only stands to be a beneficiary for the income, and they don't own the assets. This is one of the most fundamental differences between other kinds of holding property and holding through a trust. Which means a beneficiary is a person to whose benefit the properties and income of the trust has to be applied. But a beneficiary cannot have a say in terms of how the property has to be dealt with. The property has to be dealt with as it is written in the trust deed, based on the powers that are given to the trustee. The next one is the trust deed, which is the document that creates the trust. And the trust deed will have a lot of elements in terms of what is the purpose, what are the assets, how to deal with it, all the aspects that we can see. We'll discuss that about the next section. Trustee is sort of comparable to a director in a company. Okay, the trustee holds a fiduciary capacity. Okay, but he has some more aspects on income tax as well, which while we get into the income tax, we know. Trustee is given an obligation to manage the trust and apply the income, invest, dispose, defend, incur expense. All of these have to be the responsibilities of the trustee. There can be one trustee or more than one trustee. Generally, it's two trustees, two or more. Specifically, since we are discussing, so I'd like to reiterate that the trust that we are discussing here is a family trust. It's not a public charitable trust. So, I'm sorry I didn't draw this line before. It's not a public charitable trust. It's we'll just move slightly away from that part. A public charitable trust is something that is governed, and the mechanisms of a public charitable trust is very different. It's towards different aspects, towards charity, public wealth, all of that. This is in the context of family trust. In a family trust, the trustee has the obligation, once let's say they receive a property, let's say some 5 company shares, let's say some fixed deposits, some golds, etc. Now the trustee has an obligation to deploy it efficiently. Okay. And the codes of, let's say, how to use the property and all will come in the trust deed itself. Let's say if one class of asset is viewed as very risky, let's say ABC these kind of shares, this kind of crypto, this kind of real estate, this kind of a business are all prohibitively risky for the family. We can write that in the trustee. And the trustee is governed by that. They cannot deploy the funds, make sale of sort. So within the framework that is governed, that is put in the trust deed, they will have to function. Let's say a property is bestowed in the trust, and that property holds let's say a personal value for the family. So which means then at what cost that property can be disposed for raising funds or money. Okay. So that is the kind of definition that can be given within which the trustee has to function. The next one is the protector. A protector is more like an advisor. So 2-3 variants of interpretation. One is a protector is someone who has been in the similar lifetime of a settlor, who knows the purpose for which the trust deed is written. Okay. There are different purposes with which trust deeds are written in a family case. Let's say I can create a trust for one of the, let's say Mr. A can create a trust for a grandchildren to say that these funds will be used until they attain, let's say until they reach the age of marriage or once they get married. So for this fund will be used for that. This will be for their education, something of that sort. So you can define a purpose for that. Okay. So coming back to protector, one way of looking at this, protector is a person who lived along or around the time of the settler, who knows the reason or the purpose with which the trust deed is written. So that after the lifetime of the settler, if there is a doubt on the purpose, of course it's written clearly in the trust deed, but if there is an intent related question, the protector will be able to give a guidance to the trustee as to how and how to act on specific instances. Similarly, it could also be an external consultant or a professional who typically is very close to the family in close quarters. So they will be able to assess both the financial implication as well as the family dynamics in a particular instance, and they will be able to guide the trustee or the beneficiaries to that extent. And none of the decisions can be taken by the protector, it can be only taken by the trustees. Okay. And similar to, let's say, a company having 51% voting, 76% voting, 90% voting and above or unanimous, we can have the trustee resolutions can be designed in such a way that, let's say, routine matters can be designated to a power of attorney holding trustee. Let's say any value-based acquisitions or sale or mortgages of some, so that can be a simple majority of trustee. Let's say 3 people, 4 people are there as trustee. That kind of mechanism can be put forth. But just to come back, protector will not have the ability to take decisions. It is only the trustee who has to bind the trust in terms of any particular decisions to be taken. The last one is the trust asset. Like I told, the trust asset is what is contributed by the settler. The trust will also have accretion. For example, if a trust has received 10 years back certain assets from the settler, the trust will have further accretion to the trust, which means that there will be redeployment, sale, etc. And then there will be further assets that will be added. The trust deed will also stipulate how the accreted assets have to be dealt with, what kind of assets can be invested, so on and so on. So this will give you a bit of a boundary in terms of how trust functions. Because more often than not, we are used to a body corporate type functioning, let's say an LLP or a company, wherein there are definite parameters, but trust is by way of elements, it's very different from a company to put forth. Any questions until now?
The protector can be brought into the trustee.
You can bring that.
You can nominate somebody as protector.
You can either nominate a protector or you can prescribe conditions for the trustees to appoint a protector. It can be with the consent of beneficiary, without the consent of beneficiary. Those kind of aspects, depending on how the family looks at it, that's how it is. Okay, I've given here a very simple illustration of how the settlement and all of the earlier 6 elements that we discussed are captured here. Let's say Mr. A settles the property in favor of a specific trust, wherein Mr. A, his spouse and his son are beneficiaries. Mr. T, being trustee, manages the affairs of the trust. So if you see, Mr. A, who owns the properties, the real estate, shares, gold, IP rights, so those are being contributed into the trust for the benefit of Mr. A, Mrs. A and Mr. S. So here, one aspect that we will deal with at a later point of time from an income tax is that we can see that Mr. A is both the settler and the beneficiary. Okay. What kind of implications will this have? We will unfold as we get into income tax. But this is how it typically works. Trustee will manage the affairs of the trust. Assets are held in trust. Trustee will be given particular clear definitions in terms of how the trust assets has to be used, who are the beneficiaries, etc. So just to give some examples. Okay. So the trustee can specify that Mrs. A and Mr. S, they will be eligible for all the incomes from the asset but not the asset itself. Okay. And let's say that Mr. A will be the only person who will be eligible for the asset when it is disposed. Or let's say there is two classes. Let's say one class of people who are eligible for income and another class of people who will be eligible for the assets. Another, just as an illustration, what can go about is whether the income, if I receive it this year, should it be immediately passed on? Because there could be excess liquidity in each of these individuals' hands. So whether that should be passed on, because there is a person, trustee is there who is able to manage the funds. Let's say he is able to give an IRR, let's say 16%, 18%, whatever it is. So whether money should come back to the individuals at all. So we can give a condition that 40% of funds should be going back to the individual, 60% will be redeployed. And they can define, let's say there are some class of assets can be excluded, some class of assets can be included, where they can further deploy. Let's say 60% comes in every year. There should be conditions to say that in these kinds of assets there can be further exposure. In these kinds of assets there should not be an exposure. All these definitions can come in. Not entirely through the trustee, but there can be a protocol or a memorandum of sort that can be prepared within the trustee in presence of beneficiary and the settlor to document what are the things that, what are the furtherance or let's say granular details of how this should go about. Now, getting into further details, what kind of trust, what are the kinds, I mean, it's not like what are the kinds of, it's a trust, but what are the features of a trust? There is, on the top there is a discretionary trust. On the right you can see there is a revocable trust and then irrevocable and then specific. Specific and discretionary are depending on one facet. Revocable and irrevocable are the other facet. So first, revocable and irrevocable. When the settlor contributes the assets into the trust, if the settlor holds back a right to take back the asset, that's when a trust is called an revocable trust. But if the settler parts away with all the rights without any chance, without any possibility of getting it back, that's when it's called an irrevocable trust. It's very important because under the income tax law, revocable and irrevocable are treated very differently. Revocable, while we'll deal with that later, revocable is trust. In a transfer to a revocable trust is viewed as not a transfer at all. Whereas in case of an irrevocable trust, it's a genuine, the person is fully parting away with all the assets, with some assets that is defined. So this is a very important differentiation between these two classes. The other part is discretionary and specific. In a specific trust, the beneficiaries and the income that is attributable or the right of the beneficiary over the income that is established. That will say in the earlier example, Mr. A, Mrs. A and Mr. S, three people are the, let's say, beneficiaries. They stand to gain about, let's say, 40 or let's say 30%. This is a case where you have a very specific definition in terms of the beneficiary and their share in the income. Okay. Let's say if the beneficiary's names are specified but the share is not specified, then it's not a specific trust. The other one is a discretionary trust. In the discretionary trust, as the name suggests, the trustee will have the discretion to distribute the income streams, which means even if Mr. A, Mrs. A and then Mr. S are beneficiaries, the trustee will have the ability to distribute the income in the manner in which they desire. We'll not get into how frivolous can the distribution happen, but largely this is the concept, whether it is specific trust or a discretionary trust. Some trust will have elements of both. Here itself, let's say Mr. A, Mrs. A and Mr. S. In terms of real estate incomes, the proportion is 30, 40, 30. the trust deed ends with this, which means for the all other income streams, there is no guidance in terms of what is the percentage of income that they have to distribute. So the same deed will have a specific instruction for, let's say, income from real estate, which will have 30, 40, 30, and then there are other three classes where you don't have any specific instruction as to how the income will be distributed. Here as well, so depending on these four, within these four quadrants, there will be significant amount of tax differences, how they are going to be dealt with, how the trustee is going to be dealt with. More often it will not be, it will be a combination of all of this. Or let's say revocable and irrevocable are mutually exclusive, but specific discretionary, in many cases there will be a very specific instruction on specific class of asset. In certain classes there will not be any specific things. And like I told, within asset class there can be distinction, within income and wealth also there can be such difference. Income is prescribed, wealth is not prescribed. So it also, while we are discussing about it, it's also useful to look at this from the vantage of the family. How do they view particular asset? Okay. Let's say if they want to defer a decision with respect to a particular class of asset, okay, they can keep it open. Let's say, and more often in case of family trust, we will see that the trustee is the senior most, let's say mother and the father. They know what is going to happen. They will not give the affairs of the trust to somebody else. So they will know what is going to happen. So things are largely under control. And if they want to defer, yeah.
Sorry, can one of the beneficiaries also be a trustee, or it has to be someone who is not a beneficiary?
One of the beneficiaries can be a trust.
Can be a trustee.
Yeah. I'll come to that. I'll specifically, we'll discuss that structure just after this. So more often than not, we'll come across a situation where there are different asset classes, but we are not able to give a specific definition in terms of how this income is going to be distributed across the family. In that case, it can be a bit open-ended. So there's no hard and fast rule as to this has to be defined, not defined. While tax has its own complications and sort of implications, there is room for leaving it open with future instructions and an ability to amend the trust deed. So that is very important in framing the trust. And to answer your question, let's say that in this case, Mr. A, instead of him becoming a beneficiary, he can form a trust. Okay, and then that trust can become a beneficiary. Okay, and that in that trust he can define something else. Let's say, or I'm just using Mr. A just as an example. It can be Mr. A also. So let's say one of them, let's say they can create another trust, okay, in which let's say they are going to give benefit of 20% or 30% of the property for their siblings, not Mr. S siblings, but Mr. A siblings or Mrs. A siblings. Okay. So you can create another trust, make it as a beneficiary. It cannot be a settler. Okay. A trust cannot be a settler. Okay. There has to be Mr. A who has to be a settler. But Mr. A's trust or Mrs. A's trust, it can be a beneficiary to this trust. And the definition of that trust can be very different. It can be very different. It can be, let's say, 20% to, let's say, Mr. A's sibling, and then let's say 80% to charity, whatever.
The settler of the other trust.
Sorry?
The other trust which you create, that will not have a settler.
See, that need not be a settler. In that trust, how typically trust will happen is there will be a very minimal sum that a settler will contribute, and then everything else is added as contribution. So first, in that case, what will happen is that Mr. A will create, let's say, with 1,000 rupees or 10,000 rupees, he will settle it and then start the trust. And then what he will do, he will move his interest, beneficial interest in, let's say, Mr. A and Sons Trust into Mr. A and Siblings Trust. Okay. So that's how it happens when we move this. So we cannot settle, I cannot create, so Mr. A cannot create Mr. A and Siblings Trust by settling his beneficial interest in the trust. But he can form a trust and then contribute it. So it has to be done in two steps. Now once we get into tax, there will be, if you create a multiple layer trust, it is going to be very dynamic. Because I know that I'm jumping into tax, but trust is looked as a pass-through entity. From tax perspective, what is pass-through? Pass-through means we disregard the trust, we just look at who's behind the trust and then determine how it has to be taxed. The moment we have one trust and the other trust, one trust with, let's say, natural persons as beneficiary 50%, as a trust beneficiary as 50%, behind them there is another set of natural persons. So it just creates a bit of, we have to go through that. It's a bit detailed in terms of that. So this is very fundamental to understand. Just to recap, revocable, irrevocable, quite straightforward. Discretionary and specific. Discretionary and specific is not, depending on the terms of, let's say, the trust, it will vary. For example, if a trustee has a power to add beneficiary. So, Mrs. A, Mr. A, Mrs. A and Mr. S are beneficiaries, 33, 33, 33 to all incomes, all wealth. But the trustee has a power to add another beneficiary. This is a bit of a grey area, but what happens is it could potentially become a discretionary trust because trustee can add another beneficiary and change the profit share and change the income sharing ratio entirely. So it is not dynamic from a tax law perspective, but the requirements of a family is very dynamic. The view of a family towards succeeding their assets to the next generation or to the generation which is following, it's going to be very dynamic because the family's orientation is going to be important, the asset is going to be important, how they view the asset. The same family, same business can be viewed as a family to be sold to a, let's say, a PE or another acquirer or a competitor, whilst the other family might look at it as a hugely potential revenue generating asset and also sort of attaches their family to the name of the business. So every family will look at the business and the assets that they own, but it has variable considerations. So depending on those considerations, all of this will interplay with the tax. Tax is specific, but once we put the family into that, there will be like too many implications which we need to figure out. This is more like what I have told. It's written in words. Specific trust or determinate. There's one where the trustee specifically defines beneficiary or the beneficiaries, share or interest of all the beneficiaries in the income or corpus. I think it should be income and corpus. Trustees have no discretion and need to apply the income and corpus to the beneficiaries in proportion. They should apply it in the proportion. They should, what all return they generate. Whether they give it to beneficiary or not will be as per trust provision, but it accrues or renews to a particular person as prescribed on the trust. A specific trustee restricts addition of new beneficiaries as trustee's discretion. This is what we call specific trust. It will prohibit the trustee to add any new beneficiary. Now, again, in a family context, the trustee more often than not may not be a third party. It can be the family senior most men and women. So it's well within the control. Even if you put this clause, they will be able to either in the capacity of a settler or the beneficiaries together, they should be able to amend it to add new beneficiaries. So your trust will stipulate that trustees do not have the power, but there can be another mechanism where trustee, settler, beneficiary all together can amend and bring in new beneficiaries. Because if you don't, this is futuristic. Trust is a futuristic instrument which looks into future. If you don't have the ability to add new beneficiaries, it's a huge setback. Because of course family becomes larger and larger as time progresses. There will be in-laws, daughter-in-laws, son-in-law, all of them, they have to be added into the trust. So this is a provision that needs to be tied over. Discretionary trust or indeterminate trust is one where trustee does not specifically define share or interest of all the beneficiaries. Trustee have discretion to apply. trustee may choose the extent of benefit from the trust to beneficiary. Discretionary trust provides flexibility to add new beneficiaries. Revocable and irrevocable is what I have told. Irrevocable is something that can be taken back. Irrevocable is there's no taking back of assets. Okay, the reasons for trust structure. This is something that we need to spend like 2-3 minutes on, because it's very important why we look at trust structure. Separation of ownership, control, and benefits. Okay, let's say in the structure that we looked at, there are 4 kinds of properties that have gone into the trust. Now the owner of that property is the trustee on behalf of the trust. The control, it lies with the trustee. Okay. The first is not a proper ownership, it is an obligation. There is an ownership with an obligation for the trustee. Control is with the trustee, but it is as defined by the settlor. Mr. A knows that this is what can be done. Let's assume that Mr. A is the trustee also. Okay, Mr. A is holding the asset with an obligation to apply it for the other 2, let's say the children and the wife. Okay. The control is as defined under the trustee, and the benefits are going, but the benefits are going to somebody else. The benefit is going to Mrs. A and Mr. S. Let's extrapolate this into, let's say, 3 brothers, 2 sisters who have their own families with, let's say, 9 or 8 or 9 cousins. So it's spread across different people. Okay. While the first generation will be able to take control and have an ownership with an obligation to apply the income and the benefits from the trust, the benefits can go to the next generation. Effectively, it means that you are splitting the control and the benefits. Let's say if I do this in a holding company, there is still a shareholding that I have. Let's say I put all these 4 assets into a holding company. I still hold the assets through the company. I have a shareholding. There is no split of ownership and the benefits. If I do through partnership form, it's the same. If I do to LLP, it's the same. But in a trust structure, you will be able to split the ownership. The ownership is held in a fiduciary capacity, but the benefits can be defined to flow in a different manner. In a share, if I hold 10 share, dividend will come for the 10 share. But in this, I can say that 10 share is the investment I have put into the trust. This trust will distribute it in 33%. Okay. So that you have control of the asset, but the benefit is passed on to whomever you define. This is an important feature in the trust. Clarity in succession during the lifetime. Let's say in a will, let's say if a person has written a will and it's registered on, it comes into light, people know about it, but the implementation of the will comes after a person's lifetime. In a trust, you can move the assets into the trust. Every one of the family knows what is written in the trustee. So there is clarity in terms of how these assets are going to be managed. In the lifetime of a person, they can see how it is being managed. And being a trustee or the senior most person with more powers given in the trustee, let's say if there is some change that they need to do, they will be able to do it in the trustee. So there is more clarity in the succession with which is effectively happening during the lifetime of the individual. That is very important. Assets ring-fenced against personal liabilities. Again, like I told, if I put all my assets, if Mr. A puts all his assets into Mr. A company, tomorrow if there is a bank guarantee or any other implications or a personal liability that they have to go through, then the shares of holding company can be taken. Okay. But in a trustee, Mr. A doesn't hold any assets. He is holding it on behalf of 2 other persons. This is one of the mechanisms for protecting against personal liabilities. Specification of beneficial interest, we can define, we can change, that is fine. Matters like exit, so it's more return aspect. Unified representation, like I told, let's say 5 different or let's say 6 different units of a family hold let's say 10%, 20%, 30% in a listed company. It will be one trust which will control the listed company. Okay. And for example, if there is a matter which is coming up for vote, the trust will be able to have an internal mechanism as to how a vote has to happen, and then they can cast one vote, which will give you 60%, 70% in an EGM. So that is one phase for the public. Even though when we are looking at a single trust, single family, it may not be fully reflective. But if you look at, let's say, 5 families or let's say 7 families, 2-3 generations have come, all of them put together, if you want to hold shares in individual capacities, there will be 20 people in the share cap table. Those 20 people are free to decide whatever they want. Let's say if 3 people or let's say 4 persons who are holding more than 25%, if they don't desire a resolution to be passed, they can hold back the resolutions. And these are all things which theoretically I am saying, but practically also it is possible. So this gives a unified representation, and you are defining in the background of before the public, you will be able to put a single representation. Behind it, you have all the mechanics to decide how voting should happen, how the representation should happen, how this asset should happen. Let's say instead of voting, let's say if there is a potential buyer who is coming, who is approaching for acquisition of shares in a company. 5 people, if they want to sell it, they can sell 15%, 20% to that buyer, if it is kept separately. In a trust, you have all the protections to not be able to sell it. If there is going to be any decision for selling, it's the full family who is deciding. If the entire family agrees to this, all the 6-7 units of the family, they agree to the sale of 20% of stake in a listed company. It's a family decision. It will be taken as per the trust process. It's a sale. There is harmony in the family. But let's say if 2 families want to sell their shares, they just unilaterally sell the shares. That creates dissent between the family, and how that's going to be dealt with. Perhaps by selling, those families would have gotten more benefit, because they are able to time the market, they are able to get the right kind of buyer or sort. But a collective decision making is something that forms the basis of a trust mechanism, because whatever is going to be decided is already thought about and then agreed, and there's consensus in the trustee. Yeah, the next one is structured form of managing asset. You have pooled all the assets, so you'll be able to have a structured form. You will be able to have P&L, balance sheet. You will be able to have a person who's managing your family office and all of that. And then lastly, like your ability to manage assets professionally. Any doubts? Any thoughts until now? These are broadly the kind of assets.
Can a person be beneficiary in multiple trusts or single trust?
Can be multiple. This has virtually many kinds of assets: real estate, commercial properties, equity shares, debt, mutual funds, jewelry, antiques, motor vehicles, bank, brands, IPR, etc. Anything that is movable can be movable, or let's say immovable real estate property that can be contributed into a trust from a succession perspective. For formation, we'll need to know full ownership and rights over the property. Let's say if the property is jointly owned, okay, then only the ownership part will be able to transfer. If an asset is 50% owned by A and 50% by B, if A is creating an asset, he can only give 50% of his or her asset. Trust deed, defined objects or purpose. Preamble is mean, what is the purpose with which the trust is created, the objective, whether it is revocable or not, who are the beneficiaries. What we have seen is that the language of trustees is not very highly complicated legal jargons, extra. And very important, if there is any dispute or if there is any consensus building, I would say consensus building instead of a dispute mechanism, but these are mechanisms that are put in place. If there is a third party professional who has to come in, discuss, agree, all of that, that mechanism is also incorporated. Description of the properties that are being settled, declaration of intention by settlers, and beneficiaries' acceptance. And then last, this is very dynamic, the appointment rights, duties, liabilities of the trustee. what is their role in terms of managing this asset? What is the definition that a family wants to give for a trustee to operate it? Okay. So with this, I think you might have got a broad sense of how a trust, what is a trust, how does it function, and what is the settlor's role, what is a trustee's role, what is beneficiary stand to gain, how can a trustee be written, what kind of specifications you can give, what are the benefits, disadvantages, all of that. Now we'll get into the specifics of taxation of a private trust. Now when we look at taxation specifically, income tax is levied on person. The definition of person does not have trust. So which means, who is going to be taxed? Whether it is a trust who is going to be taxed, if it's not a person. There are two choices. It can be the trustee in the representative capacity, or it can be the beneficiary. So trustee in a representative capacity, trustee can be taxed in the representative capacity, or the beneficiary can be taxed at the choice of the tax officer, but both cannot be taxed simultaneously. Either in the example, Mr. A, if Mr. T, if he is a trustee, he can be taxed, or Mr. A, Mrs. A, Mr. S, they can be taxed separately, but both cannot be taxed simultaneously with respect to same income, because naturally there is no double taxation concept. But let's say if Mr. A, if the trustee files the return in the representative capacity and the assessing officer taxes the beneficiaries, logically there is no specific provision, but logically whatever tax that the trustee has paid will be creditable, will be considered as credit in the hands of the beneficiary. So there is no doubt in terms of how this will be taxed. So trustee can be taxed or the beneficiary can be taxed. So how will be the trust? How the trustee will be taxed? The trustee is a representative. So how will the trustee be taxed? There are two variations to this. One, if the trust, so before that, revocable, irrevocable, like I told, only these are applicable only in the case of irrevocable trust. In a revocable trust, naturally whatever be the income, it goes back into the hands of it gets clubbed into the person who settled it. If Mr. A has settled the trust, settled his assets into the trust, for which can be revoked, whatever income is there, it gets taxed back in the hands of Mr. A. This is in the case of irrevocable trust. The trustee is taxed. How will the trustee be taxed? So there are, like I told, here is where the specific and determinate and indeterminate trust concept comes in. In case of a specific or a determinate trust, we'll have to determine if this income, if this 30, 40, 30 is taxed in the hands of Mr. A, Mrs. A and Mr. S, what will be the tax liability? It will be the same manner in which the trustee will be taxed. So the trustee will be taxed in the same and the like manner as the beneficiary if in terms of incomes which are specifically defined to the beneficiaries. So the trustee, one important criteria is that the trustee should know how this income is going to be passed on to specific beneficiary. This is why it's a specific trust. If the trustee knows, then he'll have to file a tax return, which will potentially can be in the capacity of representative capacity of Mr. A, Mrs. A and Mr. S, saying that Mr. A's allocable income is so much.
Sorry, when you say that trustee will file a return in the representative, will it be in his own return or it's a separate return for
Good question. So trustee will file his own income tax return. Let's say if he draws salary from the trust for managing office, he will file a personal tax return. Mr. T is the trustee, he will file a tax return in his personal capacity. Then he will file another return. He will say that under section 160, I am a representative for these three persons. So I am going to file a tax return on this basis. The share of income for A is so much, S is so much, Mrs. A is so much. So this, incomes, if it is taxed in their hands, this is the tax rate. Let's say one is in 30%, one is 20%, one is 10% tax rate. This is how these incomes will be taxed, and then it will be paid by the trustee. This is in case where all the income streams are very clearly defined. The percentages, whoever is there, the percentages allocable to them are very clearly defined and mentioned. This is how it is. If it is indeterminate trust, there are certain exceptions. We'll go to that exceptions. But generally, if there, so let's take it like this. There is within a trust, there is a specific component. There is a indeterminate component. With respect to indeterminate component, the trustee will be taxed at maximum marginal rate, which is effectively the highest rate for an individual. So that is one level of complication there as well. We'll get into that specifically. So now the question is, when the trustee files a tax return in representative capacity, what should be his status? Whether it is individual, whether it is association of persons or BOI. There are some rulings on that, but by and large, since the trustee is going to be taxed in the same and like manner as the beneficiary, if all the beneficiaries of the trust are individuals, the return should be filed as an individual. But let's say if there are partnership firms beneficiary, still it is possible to file this as a individual, because an association of persons is when people come together to do objects to earn income of sort. But this is a case where one person is managing all the assets and they are not coming together of sort. So still it could be an individual.
But it will be in the hand of the trustee, the representative.
Yeah. Okay. So largely it should be taxed as mostly it will become individuals. Now, okay, I've gone into the income aspect, but ideally we should have covered the how does tax play when the actual formation of trust happens. That should be ideally the first one. Apologies for that. So first, when a person settles, let's say a property to the trust, should they pay capital gains? Answer is no. If it's an irrevocable trust, any transfer on account of transfer to an irrevocable trust is exempt under section 47(3). The complicated part, or let's say a more slightly difficult part, is, let's say, what happens in the hands of the trust or the beneficiaries. They are receiving property, there is no consideration. From a seller perspective, if there is no consideration, there is no gain, unless you are covered under section 50CA, 50C, land or unlisted shares, etc. But in the hands of the recipient, land or share or something else, if it is received by the trust without any consideration, whether section 56(2)(10) applies. For the benefit of all, section 56(2)(10) is like a gift-like tax. It's a recipient-based tax. If specific kind of property, shares, securities, immovable properties, drawings, sculptures, designs, etc., if it is received, work of art of sort, if that is received by a person without consideration or for inadequate consideration, it becomes taxed in the hands of the recipient, okay, with a corresponding step up in the cost basis for future sale. Okay. Now, all of these assets are received by the trust or settled to the trust for the benefit of the beneficiaries. Trustee is going to manage it. Now, whether section 56(2)(10) applies, because the trust has not paid any consideration for receiving this. Two parts to this. If I go slightly deeper into section 56(2)(10), it says that if a property is received from a person who is a relative solely for the benefit of their relatives, then it is exempt. Now, relative definition is something that we all know: spouse, brother or sister of spouse and their spouse, brother and sister of the spouse and their spouse, brother or sister of either of the parents and their spouse, lineal ascendant, lineal descendant. All of these are covered as relatives. Now when I give a gift, let's slightly switch. Let's say I am giving a gift. A is giving gift to B. We have to look at this relative definition from the perspective of B. From the recipient perspective, we have to see whether it is received from a relative. So I stand at one side of B and I will see whether any one of this is satisfied from this perspective. When I settle into a trust, I have to look at it from an opposite side. From Mr. A's vantage, I have to see whether B is a relative or not. Now I'll tell you there are some instances where this complication will come. It's typically where nephews or niece are involved. So if you see, for let's say from a nephew to an uncle, if you look at this, brother or sister of either of the parents, for a nephew, like in the fourth bullet, you can see that from a nephew's perspective, brother or sister of either of the parents are covered. So if a nephew is gifting to an uncle, it could work differently. But if a nephew is settling for an uncle, it will work differently because the other way is covered. So one way is covered, the other way is not covered. So this is a nuance that we have to look at when we are going to settle. Because that was one trust that we saw. Let's say there are three trusts and the beneficiaries are all the next generation, offsprings of, so Mr. A, Mr. B, Mr. C. Let's say the first example, 10 companies they own together, and these 10 companies are going to be settled into one trust. Okay, and this one trust is going to be for the benefit of 3 families plus their offsprings, let's say the next generation of their families. Then if you look at 56.210, there's an exclusion to 56.210, but you will not satisfy that. Okay. So let's say Mr. A is giving something to his nephew. This definition is not covered. This is not satisfied. So that is one important aspect for planning as to how we should do it. The other way of looking at it is, what is the trust receiving? Okay, it is receiving something. The trustee is receiving. Let's say from income tax perspective, I would like to use trustee because he or she is the one who is going to manage or receive this property, right? So if the trustee is receiving this property, they are not receiving it for their benefit. They are receiving it for the benefit of the beneficiaries. The beneficiaries cannot have the ownership of the property, but the trustee on behalf of the trust has the ownership and say of the property without any right to use the property or enjoy the property. It's an obligation. Okay. So now whatever is received, there is an equal obligation on the trustee to use that proceed not for him or her but for the beneficiaries. Going back to 56.210, 56.210 is applicable only when there is no or inadequate consideration. Okay. So when a trustee receives the property with writing out that they have an obligation to use this property only for the benefit of the beneficiaries, that could be considered as a consideration. Okay. The obligation, the trustee taking the obligation to use the property not for themselves but for the beneficiaries, that is a consideration for this property. Hence 56.210 will not be applicable. That is the first point. Okay. Technically 56.210 we can say that it may not apply, but the question arises because there is an exception to it, because what is not covered cannot be excluded, right? So when something is specifically excluded, then we think as to, okay, if this is covered only then something can be excluded. Whatever is not included cannot be excluded, right? So this is more interpretative. Whether something, if it is excluded, then it is automatically included. Those are our interpretative aspect. But 2 lines of argument. One, the trust settling to a trust for beneficiaries should not trigger 56(2)(10) because it's only an obligation. They are not going to enjoy the property by themselves. The second layer is we are trying to satisfy this condition. Okay. Now, once the trust receives the property, receives the shares, immovable properties, whatever it is, if they tomorrow sell it, what will be the cost of acquisition and period of holding? 47(3) recognizes the transfer to be exempt. You have all references to 47(3) in section 49 and 242A, which means your period of holding and cost of acquisition will be the cost of acquisition and period of holding from the settler's sense. So that's one less worry. So, yeah, there is one judgment also which has held that ownership means the ability to use the property for their own purpose, which is not there in a trustee's case. Okay, so this is the illustration that I had given. Mr. A directly gives the property to B's son or daughter. Okay. Mr. A's son gives the property to Mr. B's son. Mr. A settled property into a trust where B's children are beneficiary. Now, yeah, so that perspective has to be changed when we look at gift and vis-a-vis settlement to a trust. Okay, the next one is on clubbing of income in a revocable trust. Sorry.
It can be possibly done, even if you're giving it to an insurance.
You have to fall back on the first principles as to that cannot be if a person does not have the ownership of the property, clear ownership for them to use and dispose and enjoy all the benefit, then it's effectively not a ownership of the property. Right? For a trustee is going to be asset or beneficiary is going to be asset. Beneficiary do not have the right to sell the property in the way in which they want to.
If beneficiary is not a special add-on, let's say if they are friends or let's say anybody else, any ex-person, can that also be done?
That's what. So same argument will apply. Only that you cannot take recourse under the exception. More often than not, family's succession, somehow we can try and fit into the exclusion also. But there will be, if the family is bigger, let's say 3 generation, 4 generation, then we have to fall back to this argument that I told. That a trustee cannot be taxed because they don't have the full right over the property in terms of utilization, because it comes with a rider.
Beneficiary also will not be taxed?
No, beneficiary also. Because the beneficiary is not receiving the property. No?
They are receiving the income on it or whatever.
So 56(2)(10) does not tax the income from the property, it taxes the property. Beneficiary doesn't receive the property, trustee receives the property, but they don't have, along with that there is an obligation to use it.
Can this not be misused?
See, it cannot be because, so I'll give you one more example, a family settlement point. Okay. I told that there are 3 families and they are settling real estate, gold, shares between each other. So plain reading, there is transfer of shares, there is transfer of immovable property, there is transfer of gold. And then A is giving to B, B is giving to A, which means the consideration for A to B is the consideration for B to A. Let's assume that each of these are transacting at fair market value. But that is not the case. The question is, because it's a very different case. This is not a case where a person is dealing with a third party. It's a case where people are dealing within family. So within family, there is a concept that there is an antecedent title, because Mr. A is owning 33. All 3 are owning, let's say, 33 in a company. But this is a company which is started and run by Mr. B. So there is an understanding between A, B, C that B is entitled to all the benefits of this company. Okay. B, although he owns only 33% in a company, there is an understanding between A, B, C, unwritten understanding that Mr. B is the one who will be entitled to all the benefits of this company. Similarly, let's say the second company, similarly 33% owned, but it belongs to C. There's another company, 33% owned, belongs to A. what courts have told is, if there is an understanding that there is an antecedent title, which means that people are of the understanding, all three are of the understanding, that the 100% of this company goes to B, 100% of this goes to A, and 100% of this goes to C, any realignment between them will not be subject to capital gains tax. Because there is no transfer in the first place. Because in the minds of those three, it is always that every one of them owns 100%. And they are doing it, let's say, for preventing any dispute. Or let's say there is already a dispute. In light of that dispute, they are correcting what they are already having. It is not viewed as like a transfer, it is viewed as correcting the ownership, which was in the minds of the family members. But on records, they are just correcting all of it. They are not transferring it to get benefit. You are able to follow what I am saying? So in a trust, when you are setting up a trust, you are not transferring anything. You are controlling it through a different mechanism. There is no gain in that. There has to be a gain, there has to be an income, there has to be a benefit. So when you look at section 224 income, there are specific limbs which are brought into it. So section 56.210 is an artificial way of, is a deeming fiction which taxes it. It's not naturally an income. Right? Somebody is receiving some goods or let's say shares, but they are taxed. How is the recipient being taxed? It's a deeming fiction. Okay. So in this case, Mr. A, in this case, let's assume that Mr. A is also a trustee of sort, or he is transferring for his family's benefit. Situation has not changed. It is Mr. A's property, it is being used for the three persons who are the beneficiaries. Nothing has changed. It's only him defining it. So that's the difference between a normal transfer and this kind of a transfer. And generally this is done within the family only. It is not done in such a way that a third party is brought in, because that will have different implications. Commercially it may not work for a third party to be brought in. Because let's say if I have to give a property to a third party and I put that into a trust, with trustee having conditions, but the third party wants to use that property, okay, they will not, the beneficiary will not have free hand in terms of selling the property. So that there are differences in terms of dealing within family and third parties. Any other questions? Okay, the next one is on 64.1. These are cases where, let's say, if assets are transferred to the next generation, to the spouse, without benefit of sort, effectively there is a clubbing provision. This is important because, let's say, in a trust, there is a minor son or minor daughter who is involved, who is a beneficiary, and we have to determine what is the tax that is applicable on the income that is attributable to that minor. We need to know that by virtue of this clubbing provision, the minor's income will be clubbed with his father or mother who has the higher income. So in a way we have to determine for every individual who is a beneficiary, since they have not got these assets by virtue of their earning, it's more like a gift of sort. So how will this income be taxed? It will not be taxed in their hands, it will be clubbed. So to that extent, we have to go back, trace everybody's income, and then the trustee will have to file the tax return in representative capacity. Okay, this is a short summary. Specific trust where the income does not include business profit. Income is taxed in the like and same extent as it would be levied in the hands of the beneficiary. Like I told, 30%, 20%, 10%. You have to compute for each person and then add it. In a specific trust, if the trust carries out any business activity, then the income, the business income and the whole of the income will be taxed under maximum marginal rate. That is prescribed. So there are some exceptions to that. Let's say the trust is declared by the will and it is for the dependent relative, and the trust is the only settler declared by the settler. These are three cases when the maximum marginal rate will not apply. You will go back to the individual slab rate. In terms of discretionary trust, it will always be taxed at maximum marginal rate. So in a trust, there is one more point that we have to bear in mind. When we say that the income is going to be received by the beneficiary, cash flow could differ, like I told. Cash flow could differ. 100 rupees of income that is received today, 40% could be passed on to the beneficiaries this year, 60% will be accumulated. But the 100 rupees has to be taxed. Right? The 40 rupee can be passed on next year also. So cash flow and this will be quite different. The income earning will be different. Particularly because I know that accrual and receipt are always at maybe a different point of time, but here there is one more layer. There is a receipt, there is an accrual by the payer, there is a receipt at the trust, and then there is a receipt at the beneficiary. So there is one more layer we have to go through. So there will be differences from a cash flow perspective. Tax shall be chargeable as if it were an AOP. So there is not much of a difference between tax rate for an AOP and an individual. So MMR is largely where the discretionary trust will fall. Beneficiaries have other income less than basic exemption and are not beneficiary in any other trust. Trust created through will and is the only trust created by the settlor. Trust is non-testimony trust created before so. So non-testimony trust is when a trust is created by virtue of a will. So let's say a person writes a will and says that ABC are the assets, Mr. X is the trustee, PQ are the who are the beneficiaries. It has to be managed in so and so fashion. So the will lead to a trust. So that is called a testimony trust. A trust created on behalf of any funds for the benefit of the employee. So these are cases where it will be tax will be charged at AOP rate. AOP rate and individual rate are almost same. Not much of a difference except for surcharge, etc. This is how it will be taxed. So these are some precedents that we thought that I thought I'll just put this for our discussion. AO to assess the beneficiaries directly. So like I told, there is an option that is given between for the AO to assess whether the beneficiary or the trustee, depending on whether they choose to tax somebody. It's not dependent particularly on filing of return of income. Let's say if a trustee files a tax return, they can also go and tax the beneficiary, but the credits will have to flow appropriately. That is one important aspect. Trustee will have to be taxed in the same and the like manner, which means I don't know whether 1 second. Okay. So that is one other question which I think it's in the next slide. It will be taxed in the like and to the same extent. So if all procedures that the tax officer has to do will be as if they are assessing the beneficiary. Okay, there cannot be a change in tax rate. There cannot be a recharacterization of income. Let's say if a house property business income, there cannot be a recharacterization. There cannot be more tax that they can charge merely because let's say a representative is at 30% and the beneficiary is at 15% tax. They cannot be changed. It's the same and the like manner. And the trustee will have, if whatever tax is being paid by the trustee, they will have the ability to recover it from, let's say, the trust or the beneficiary if the income is already passed on. Typically how they do, they will withhold the taxes, they will hold back the amount that is required for payment of taxes, and then balance is only distributed. Okay, now this is one important aspect. What is the maximum marginal rate? We discussed about this in this discretionary trust and specific trust in two places. What is a maximum marginal rate? And this question arises more often in trust because it holds shares, immovable properties. Maximum marginal rate is it the rate? It's effectively the highest rate that is applicable for an individual. So does it mean that a capital gains, which is otherwise taxed at 15% now, whether it will be taxed at 40%? That's the question. Whether if it just says that it's a maximum marginal rate applicable for an individual. The highest maximum marginal rate is defined as the highest rate that is prescribed under the Finance Act for an individual. This is a point of interpretation, but it's fairly okay to take a position that you can apply capital gains tax rate for capital gains income, and for other cases where there is no specific rate, you can apply the individual maximum marginal rate. So this is an interpretation that you can take because of multiple reasons. One is merely because, so I go back to the same and like manner. So let's say if an individual is taxed on sale of shares or immobile properties, the capital gains will be taxed at 15%. Okay. Merely because the situation has changed from individual to a trustee, tax rate cannot go up to 30%. This is one of the fundamental reasons. Second point is maximum marginal rate is specified as highest rate applicable for an individual as per Finance Act, and the highest rate we should look at it qua the income stream, not without, let's say, whatever be the highest that's not the position. You have to take with respect to a particular income, what is the highest rate that is prescribed. So with respect to capital gains, it's 12.5%. So that is the highest rate at which this income can be taxed. Okay. There are a couple of jurisprudence also in this context. Okay. So this is a case where whether the trust can be regarded as discretionary if the beneficiary does not exist at the time of trustee. I just read this out. As I say, has four trusts, out of which 2 trusts were created for the benefit of would-be son-in-law of the settler, and the other 2 trusts were created for the benefit of would-be daughter-in-law. It was provided that the trustee that if the intended marriage did not take place within 20 years for any unforeseen reason, the trust property would become reinvested in the settler as a beneficial owner. So if there's a beneficiary, or let's say if there's a possibility of adding somebody else as beneficiary, if the trustee has the ability to change the ratio remotely, that is when you call a trust as discretionary trust. So when somebody is, it's for somebody else, it is defined. That person is not existent right now. But the definitions in terms of how this income has to be applied, to whom, that is specified. So to that extent, there is no, this cannot be regarded as a discretionary trust. That was the point of view. Whether section 164 applies when distribution of income is not defined. So this is a case where, like I told, this is a cash flow point. I think in this case there was 10% has to be distributed, 90% has to be kept back. Now the question is, in a discretionary trust, okay, when if let's say in a discretionary trust, if the distribution happens in the same year, possibly one can say that the beneficiary are known, right? Because the distribution happens before the tax return is filed. But let's say if the distribution happens in the subsequent year, today only 10% is distributed, 90% gets distributed next year, but there is no definition for that 90%. So whether this will become a discretionary trust, whether it has to be defined based on the distribution, it's not linked to the distribution of asset or distribution of income. It depends on the trust defining how much can be distributed. If the trust has defined that ABC has 30, 40, 30, 20, 20, 60, if that is defined, distribution doesn't matter. So that is one example.
So if say the reverse case where it's a discretionary trust, the trust is not defined anything. But let's say the trust has a general practice of giving 33, 33, 33. Can I still go ahead and file in that manner?
No, so that's the point. That is a discretion that is used by the trustee to distribute it in one-third manner. It's not coming out of the trust. It's not the view of the settler or who has put the trust. It's still a discretion of the trustee. So to that extent, it will still be regarded as discretionary trust. Okay, interestingly, there's one more judgment. I think it's not here. It's a case where there are 2 categories of beneficiaries: income beneficiaries and wealth, let's say property, corpus beneficiaries. The income beneficiaries are defined, whatever percentage it is, and the wealth beneficiaries are undefined. The income beneficiary, so as per the trustee, the income should never be distributed. The income should always be plowed back. So effectively it means that every year there is income that is coming. the income is getting redeployed as per the trust rules. And at the end of the trust, effectively it's the corpus that is going to be distributed, which is to the next class of beneficiaries who are entitled to the corpus, who are not defined. Right? So which means, whatever that I told now, the other ruling defies this logic. Right? So the next set of, in the second ruling that I mentioned, the income beneficiaries are defined, but there is, as per the trustee, there is no distribution that is going to happen to that extent. It is only going to be corpus accretion, and that corpus accretion, to whom it is going to go, in what percentage, that is not defined. So when the trustee is looked at, it is looked at in substance, whether it is discretionary. Effectively, the intent of the one who has written the trust, it shows that there will be income, it will be distributed in a future time when the trust is ended, and that can go to anybody whom they desire. Like say, in this 3 people, in the manner in which they desire. If that is how the intent is coming out in the trust deed, then it was viewed as a discretionary trust. Okay. Can the officer recover tax from the beneficiary in respect of income distributed if already the trustee has paid taxes? Then they cannot do a second time recovery. Whatever, they can assess it. Let's say if the trustee has filed a tax return, and if the tax officer were to assess the beneficiary, they can assess it. Same income, they can assess it. But if there is any differential tax, that is the amount that they can collect. The tax cannot be collected twice on the same income. Okay, this is fine. Taxation of donation received by a trust. If it is received by a trust, donation, somebody is giving a donation to the trust, this is not a public charitable trust. So any donation that somebody receives, any money that they receive without the consideration will be taxed under 56. Okay, converting nature of trust to be from a discretionary to specific. This is one other important point. Because like I told, since the requirements of a family could be dynamic, today you start the trust deed with, let's say, 5 people, 20% each. Tomorrow, if in the next year you are going to redefine the trust, let's say from 20% all of this, you just restrict that 20% to a particular class of asset, which means the other incomes will not be specifically defined. It will become discretionary. So the trust will be specific trust for the first year. Second year it will become discretionary trust. For every year we have to look at whether the status of the trust is specific or discretionary. Okay, this is something that makes sense. Testing for revocability. Revocability is something. So here it was a case where whether there is a corporate will, etc. There is no corporate will in trust. Basically, if there are conditions that allows a settler to take back the asset in a distant future or immediately, it means that it's revocable. So it will just go back to a revocable status. Applicability of AOP. This is something that we discussed. Okay. So effectively, it's like MMR or AOP. That is where we are coming to. And in case of MMR, if there is capital gains, you have the ability to take the capital gains tax rate. That is possible. But how to file the tax return? Let's say in a specific trust, it is, while filing the tax return, you have a definition in terms of who all are the income earners, and to that extent you can file, the trustee can file. If there is no definition, then we go back to MMR or AOP rates. If there is business income, it doesn't go. I mean, like, it will always be MMR, whether it is discretionary or otherwise. So that's the flow in terms of income streams. Tomorrow, if the trust property goes back to if it is settled or if it's given to the beneficiary, yeah. So what will be the tax implication? They are already beneficial. They stand benefit to those assets, income streams. Incomes would have already been taxed, potentially assets. Assets, they are already holding beneficial interest. So to that extent, whenever the money goes from the trust to the beneficiary, or the asset goes from the beneficiary to the individual. So from the trust to the individual, there is no tax levy in that lane. So effectively, what we've covered is how do you get into a trust, and then how the trust is taxed, and then how the settlement or coming out of trust happens. So typically, when we do all of this, while I cover the income tax part, there is also a stamp duty element that we all have to be wary of. For immovable property, when we move it into a trust, there will be a conveyance stamp duty, 7% plus 2%. That's the stamp duty. For a share transfer, it's depending on states, it could differ. Let's say there can be two rates, 0.015% or 0.05%. So that kind of a stamp duty is something that we should look at. Before the settlement or after the settlement, there can be certain rebalancing of assets. For example, how it typically could happen is that if the family has multiple assets, they may choose to bring that into a trust, some assets into the trust, and then rebalance the other assets. So when we move, whatever gets moved into the trust, this is how the taxation will work, while getting in and then income earning and then getting out from the trust. But there will be other kinds of transactions that will happen in the periphery, because let's say if there are multiple families holding different assets, they choose to bring only, let's say, 50% of assets into the trust, and the first generation they want to still hold let's say 50% of it in their name. There will be some amount of rejig that will happen between themselves, whether it could be a gift or like a family settlement that I told, is something that we need to anticipate, because with respect to trust, it's not only one particular solution, it's about other aspects also. It's like a holistically we have to look at it. Let's say 5 families or 7 families, 3 families coming together. If they are going to go into trust, peripheral activities like settlement, gifting, transfers, cash settlements, funding, etc., all of this will happen. So that's one thing that we need to bear in mind. Other than this, I think we are in the fag end, but I think there are 2-3 other aspects that I wanted to cover. One is from a SEBI perspective. Let's say when we are dealing with listed companies, promoter has owned the company and they have taken it to public, and then let's say 10 years down the line, if they are planning to do a succession planning, they have to move it to a trust. They have to settle it to a trust. Let's say 40%, 50%, 60%. If they sell it to a trust, if they settle it to a trust, the change, the ownership changes from a individual to a trust or a group of individuals to a trust. So when there is more than 25% change in ownership, you trigger an open offer. So we have a trust who is going to take over 50% of shares in a listed company. Then typically what happens is, since the trust is going to be an owner for more than 25%, they'll have to trigger an open offer, which means all the other public will have to be given an offer for selling shares to the trust. It's not warranted because the trust is not acquiring like a third party to have a control over the company. It's basically an internal family settlement, but by virtue of the rules under the takeover code, this gets triggered. So for that, so there are specific informal guidance that a company has, that the promoter has to obtain for this transaction to be exempt from a takeover code perspective. So this is one aspect, and what is looked at from a takeover code exemption perspective is that the trustee and beneficiary should continue to be relatives of the settler. The settler, when they are settling the shares to a trust, the trustee who controls the share, which means trustee will vote for the 50%. Right? So the trustee will exercise voting right, they will have dividend right. All these rights will come in. They'll have board of directors, they can appoint by virtue of that. So which means to ensure that this is only a family arrangement and not an indirect way of passing on control over a significantly valuable company, the conditions that SEBI typically looks at is that on a year-on-year basis, there has to be a certification to say that the trustee as well as beneficiary of the trust are relatives or immediate family relatives of the settler. So this is one thing that we need to be wary of. Let's say whenever we are discussing about succession planning to our clients, if there is a listed company involved, then we should think of this particular aspect, because invariably we will know that our client could be somebody who's holding a significant stake, and if they want to pass it on into the trust, this is one particular trigger that will happen, and this is one aspect. The second aspect is that when I told like and same manner, I missed this particular aspect. This is also important, is that more often the family members could have gone outside of India. They will become residents of other countries, and a family's assets and wealth could be spread across multiple countries, multiple places. So when we draw a trust deed, okay, we need to factor two important things. Who are the beneficiaries? In fact, who are the beneficiaries? Whether there are any non-residents who are becoming a beneficiary of an Indian asset by virtue of this settlement. Okay, which means effectively it's like just to give an example, under the foreign direct investment rules, passing of assets to a non-resident by virtue of inheritance or will is in a way permitted. It's still viewed as a domestic investment even if it goes to a non-resident. But when you go through a trust, how is this going to be permissible? Let's say Mr. A holds, in the same example, Mr. A holds shares in his company, but Mr. S is a non-resident. Is this permissible or not? That's an important question that will come out. Second point is, they also have real estate assets. So whether Mr. S is entitled to it, that's another question. From a tax perspective, let's say if we cross those FEMA aspects and we say that Mr. S is permitted to become a beneficiary of this trust. Let's say if there is a dividend income that comes to the trust and the trustee has to file a tax. Now, based on the rules that I told, how will you look at that particular income for Mr. S? So Mr. S is, let's say, a resident of Singapore. Okay, so there are three layers. There's an Indian company, there's a trust, there's Mr. S. Mr. A, Mr. C and Mr. S. So the income goes to the trust, and the trustee has to file a tax return saying that these are the shares, 33, 33, 33. And Mr. S stands to gain 33% of this dividend. What is the tax rate that he would? Let's assume that he is getting 10 crore of dividend from the company. We'll have to look at India, Singapore DTAA. If it is 10% or 15%, that is the rate that will be applicable here. Surcharge will not apply. So this is how we have to go through layers to understand how each of these incomes are. Now flipping back the point, let's assume that Mr. A is a non-resident, okay, and he has assets outside of India, okay, and he is settling it into a foreign trust. And can if Mr. S is a resident of India, can he become a beneficiary of that? Because effectively he is going to be holding an overseas direct investment. Okay. Those shares are outside of India. So residents have certain limitations with respect to owning shares outside of India and immobile properties outside of India. Whether this could be permissible, and if it's permissible, we'll also have to take a logical conclusion as to, let's say in case of an unfortunate event, Mr. A and Mr. C are not there, can Mr. S be able to get the title over that property by virtue of this trust settling it? So for any kind of these settlement, what we have to also look at is logically, does it ending, whether it is possible to take back the assets. So once you are putting the assets into a trust, we'll also have to look at how these assets can be taken up, whether there is any risk exposure of that sort. So the FEMA aspect is very important. Money is fine, you can go up to LRS limit, you can get all of that is fine, but if there are assets immovable property and shares of sort. So you need to see whether, so where is the trust located, Indian trust or an overseas trust? Who's getting beneficiary of the asset, whether it is Indian asset, sorry, a foreign beneficiary becoming a beneficiary for an Indian asset, or an Indian beneficiary becoming a beneficiary of the foreign asset.
But an Indian trust can also manage the foreign property.
Foreign?
Foreign, let's say, immovable property. Can an Indian trust manage?
See, if the Indian person has bought it validly, then he can move it. But I think Indian individual cannot directly buy foreign real estate. They will have to necessarily go through a company and then only buy real estate. That also they can do it, buy it for business. So, I'm just not getting into that specific because there are some layers in that. But so 2-3 things, like one aspect, like we have covered the Income Tax Act in slightly a longer detail, but additional aspects that I wanted to share was, one, the SEBI, because invariably we will come across this. 2, which is also quite very much possible in discussing on succession plan, is the residency and the assets, because now assets are going to be spread across multiple jurisdictions, and the family could also be spread across multiple jurisdictions. So these are a couple of other points that I want to share. Of course, more of food for thought for all of us. So that's about it. Any questions or any things that you want to discuss or something, feel free to.
Just a general question. Let's say after the time of the SIRC, there's a dispute between trustee and the beneficiaries. How does that work?
There should be a dispute resolution mechanism in place. So, for example, there can be instructions or, let's say, inputs from the settler as to how disputes have to be resolved, etc. But see, that's just one more aspect. See, trustee risk is something that will get should get revisited, let's say, every 5 years or 10 years once, because lot would have changed in terms of the assets that they are dealing with, how they are dealing with, and to be like future ready. So this is one important aspect. Let's say, depending on the mindset of different factions of the family and how a person is inclined to look at things, because these are all personal decisions that everyone takes. So there should be every let's say 5 years or 7 years once, we have to look at how the dispute resolution mechanism works. How can external parties to be brought in for resolving some of this, whether mediation is something that they can look at. So all of this mechanism can be put in place, and unfortunately consensus is something that can be brought up only from a person who is dissenting, but there is a roadmap for that. It can also not be seen if there is no trustee. Individuals who are owning will be left to their choice to deal with the asset. But if there is trust, if there is a larger purpose, it just gets into the trust, and there are safeguards to that extent. There can also be safeguards such as, if something happens, if there is change in minds of sort, can income be limited to a particular person, or can one person alone exit, or one family alone exit? All these are quite flexible to that extent.
What happens when the settler himself is the trustee and the beneficiary?
That's a revocable trust, effectively.
If a settler is a beneficiary and a trustee,
Yeah, it's effectively that. It's that sort. It's like I have moved an asset into a trust with the decision making in with me for the benefit of myself. Indirectly it's a revocable trust. While you would have not told that in these situations the asset will come back to me, but you have given yourself all the powers to give it back to you.
just alone, if the trustee is someone else, then it's not a.
See, even otherwise, it's a borderline case where you get into revocable, because effectively, ultimately, this is going to be come back. This is going to come back to me myself. Even though I have settled, ultimately it is going to come back to myself because I am the beneficiary. And you don't know how much powers you are given to the trustee, whether you are given a power to add somebody else, all of those questions remains, but it's going very close to revocable trust.
In such cases, even if the income is not distributed, I have to pay out.
Income distribution is never a factor for taxation.
Whatever is earned, then I have to pay.
You have to pay. It's clubbed directly with the yeah. Because anyway, you as a personal capacity, let's say this individual as a personal capacity, in their representative capacity, if at all this is not, it's coming back to the same person. So in their individual tax expenses, they have to add all.